This is 2000 and 2008 all over again. One more macro change that's coming in that's going to cause huge problems. I'm afraid we're going into the biggest stock market crash in history. It's going to affect everything we do. And people are still sitting around saying, oh, real estate always goes up. Oh, my house went up in value. Oh, I'm going to save more money. Oh, I'm going back to college, get my master's degree, maybe become a doctor. And not to confuse people, but there's a thing called the repo market and reverse repo market. And those things are coming apart at the seams. Now, most people will say, oh, good, I'm going to stay out of real estate, when it's really the best time to get into real estate, but you better be educated. So we have a lot of stupid people in the market. That's bad news for stupid people, but good news for smart people. Because, in 2008, Kim and I made more money in 2008 as the market crashed. It crashed and it gave the best real estate in the world went on sale. But the average person was saying, oh, I don't want to fix toilets. I said, because you're an idiot. I mean, Jesus, they're giving this stuff away. They were like Neiman Marcus put in, Gucci on sale, and all the idiots run away from it. But the reason we do this, and we do this with Rich Dad's world, is you need more education, not less, but also who do you take education from? The big reason why real estate is more crucial than stupid 401k investors is because real estate is illiquid. You buy it, you own it. If it's bad, you're gonna go down with it. And if it's good, you look like the second coming of Jesus or something. You look like the genius.
The good news is if you were to go to Neiman Marcus, use your example, and say, and they said, well, we'll give you a 20% discount or 30% discount, you'd be there first thing in the morning. You'd be lined up. And yet that's what the government's offering. They're offering, if you invest the right way and you have the right advisors, they're saying, look, we'll give you a 30, 40% discount on your investments. Even if it's a tough market, even if the prices seem high, like they do now, the government's still giving you a 40% discount through tax incentives. So that's why the taxes play such a big part.
And the average person goes, well, how come I'm paying 18% on my credit card? Because you're stupid. You're freaking stupid. You don't know good debt from bad debt. And it's people like you should listen to Dave Ramsey and live debt-free. So welcome to the program for the first time, Jason.
Yeah, thank you, Robert. Appreciate it. And Kim, too. What you said is so true. And this is a scary time, but it's at the same time, it's a time of opportunity, like you mentioned with what you and Kim did during the Great Recession. And Tom also, mentioning that the government is essentially subsidizing real estate investors, not only through the tax code, as he was referring to, but also through these government-sponsored entities like Fannie Mae and Freddie Mac that buy the vast majority of these mortgage loans, the debt, as you were talking about. And then it gets better because you rent the house out or the apartment building out, and your tenant pays that debt for you. And then you get a tax deduction. You're literally getting paid to borrow money. It's an incredible opportunity. Where we're seeing the opportunities are in these good, solid, linear markets, these cash flow oriented markets that aren't expensive, and they are business friendly and they are landlord friendly. So you don't have this type of environment where if you have to kick a tenant out because they're not upholding their contract, that you're looked at in the courtroom as the big evil landlord that may have one house, right, that you're trying to use for your retirement. That's not a big evil landlord, okay? It's ridiculousness. So, in places like New York and California, people can squat in your property for just amazing amounts of time if they know how to work the system. In Arizona, it's the opposite. In Texas, it's the opposite. In Florida, it's the opposite. Tennessee, even Georgia, these are more landlord-friendly, more business-friendly places, and these are the places with the growth. And they want their cost of living to be lower, and oddly, their quality of life is higher. for less money. It's just a great deal, and many of them can work remotely. So I would say that the important thing is to do your due diligence. A lot of that can be done online now. There are so many tools, just starting with good old Google Maps and Street View and looking at the neighborhood, looking at the demographics, and we help people research all that stuff. And we recommend that people invest in at least 3 markets, but not more than 5. Back in 2004, when I started investing nationwide, I made a huge mistake, and people can learn from my mistake. I was in 17 markets at one point. That was a mistake, right? That's going to the all-you-can-eat buffet and, binging too much, right? So 3 to 5 markets, and you'll be well diversified. Good linear markets, meaning these markets where they don't make the news. These are markets that are somewhat boring, really, but they're good investment markets. They're not sensational. They don't have big swings, big ups and downs, necessity-oriented housing that people need, housing that's in and around the $200,000 mark. I used to say, by the way, $120,000 mark, but prices have changed. And that's another reason to do what you and Robert recommend, which is using debt. And Tom, of course, spoke to the tax benefits of that. So
the other thing you can do, if you're looking at, okay, what market is going to be investor friendly, you can actually start. I start by looking at what do their taxes look like, right? I mean, it's not surprising or shocking that the high tax states are also the low business states. Right. They're also, the low investor states. You have the low tax states. Arizona just cut its tax rates in half. You've got Texas with almost a zero tax rate. You've got Georgia with low tax rates, Florida with a zero tax rate. So you've got these states in Nevada, Utah, all have low tax rates. Well, guess what? That tells you that that's a business-friendly environment. That tells you that they're trying to encourage people to come in instead of pushing people away, which is what the high tax states are doing.
Absolutely. What gets rewarded gets repeated. And, they're rewarding businesses. They're rewarding money. Money always goes where it's treated best. And that's what you want to follow, that trend. The places that treat money well are the places that you want to invest in.
And anybody who supports higher taxes is a Marxist. And when I tell people we don't pay taxes, they think I'm a criminal. No, I'm a capitalist.
Yeah.
You want to be a Marxist, pay taxes. Marx was the guy that said, you want to kill capitalism? It's higher income taxes and inflation. And that's what they're doing. So let me explain one more macro change that's coming in that's going to cause huge problems. Now, huge problems means huge opportunities. I'm afraid we're going into the biggest stock market crash in history. It's going to affect everything we do. And people are still sitting around saying, oh, real estate always goes up. Oh, my house went up in value. Oh, I'm going to save more money. Oh, I'm going back to college, get my master's degree, maybe become a doctor. Tom, who pays the highest taxes?
Doctors.
We're just going to see, there's a lot of upward pressure on rents now, but I think we're going to see a lot more upward pressure on rents over the next 5 to 10 years. And I think we're going to see a decline in the standard of living for a lot of people, unfortunately.
For most people, they're going to get wiped out because they went to frickin' school and they listened to Marxists telling them that paying taxes is good and you should get out of debt because debt is bad. But at Rich Dad, debt is good because it's tax-free, right, Tom?
Not only is it tax-free, but all those deductions you get from investing in hard assets, you're just compounding your tax benefits because you're using the bank's money. The bank doesn't get the deductions for depreciation or intangible drilling costs or anything else. They don't get any deductions. What they do is they give you the money and you can use their money to get deductions against your income. So you're compounding not just your return on investment, but you're also compounding your tax benefit by borrowing. So I can't imagine going into real estate without borrowing because you lose so much of the tax benefit. Literally, you lose 80% of the tax benefit if you use your own money as opposed to borrowing and using the bank's money.